Over the next few weeks, up to $95 billion in equity will be mechanically liquidated from the open market. That capital is being drained directly from Wall Street's 8 largest technology stocks, specifically targets like Microsoft, Apple, and Nvidia. When trading desks see an outflow of this magnitude hitting the tape, the immediate instinct is to assume a macroeconomic top or a sudden collapse in tech fundamentals. But the balance sheets remain pristine. Forward earnings projections and revenue growth across these exact companies show no signs of structural failure. The warning sirens aren't coming from fundamental analysts. They are coming from the quantitative strategy desks at JPMorgan, identifying a systematic distortion. This $95 billion sell-off is disconnected from organic market sentiment. It is a mechanical friction event in the underlying plumbing of the equity markets. Nasdaq's Internal Index Administration recently updated its fast-track protocols, creating a mandate for passive ETF managers to execute blind, algorithmic liquidations. For institutional traders, mapping this forced liquidation reveals specific, temporary tracking deviations, mathematically certain mispricings that occur entirely outside of fundamental shifts. To understand why a rule change finishes a sell-off, you have to look at the rigid legal mandate governing passive fund management, the absolute requirement to precisely mirror a target index. That target index dictates exactly how much of a specific company the ETF must hold, a ratio driven by market capitalization weighting. A passive ETF operates as a strictly closed system with a 100% capacity limit. Inside, the market caps of the top 8 companies monopolize the available volume, squeezing remaining constituents to the bottom. They carry zero cash reserves, remaining fully invested at all times. Under normal conditions, keeping this system balanced is a slow process. Index weights drift slightly, and managers adjust their holdings through tiny, steady-state trades. These adjustments are executed on highly telegraphed quarterly schedules, giving market makers months of runway to absorb the incoming order flow. But because the ETF is already 100% full, any sudden requirement to allocate space for a new asset demands an immediate, equal ejection of existing capital. That mathematical requirement is triggered when standard quarterly cycles are interrupted by out-of-band administrative events. The primary disruptor is Nasdaq's 15-day fast-track rule, an administrative shortcut designed to quickly onboard new, massive market entrants. This timeline contrasts the standard adjustment period with the fast-track rule, which mandates new entrants be absorbed in just 15 days. This aggressively compresses the timeframe, giving passive managers less than 3 weeks to prepare for a multi-billion-dollar shift. Institutional ETF infrastructure is built for steady-state tracking, leaving the system's plumbing ill-equipped to process sudden, multi-billion-dollar capital migrations. By utilizing the fast-track rule, index administrators bypass the standard volume limits and impact mitigation protocols built into a normal quarterly rollout. ETF managers have no choice but to instantly acquire the new asset at its full mandated weight the moment it is included in the index. The 15-day rule turns a simple update into a zero-sum structural crisis. Passive managers must locate billions of dollars in liquidity in a matter of days. Looking back at our fully allocated ETF tank, the new MEBECA capset is wedged into the top layer. To maintain 100% capacity while absorbing this volume, the ETF must systematically shrink existing holdings, ejecting billions of dollars. The internal algorithms target the heaviest weights first. By mathematical necessity, the largest incumbent in the index, Apple, is automatically targeted for liquidation. Microsoft, as the second heaviest weight, absorbs the next massive block of forced outflows. The drain continues down the heavyweight tier, forcing capital out of Nvidia and Google. These passive systems do not read earnings reports or evaluate technical support levels. The selling is price agnostic. The algorithm simply divides the required capital by the target weights and executes the trades to meet the pro rata allocation math. When those mechanical sell orders leave the internal ETF plumbing, they hit the public exchanges as a simultaneous $95 billion wave of supply. This order book depth chart shows the result. A spike in active sell orders collides with a thin layer of historical buy liquidity. Normal daily trading volume cannot absorb this influx. The resulting gap creates a microstructure bottleneck where intense sell pressure overwhelms available buyers. The index rule change has manifested as a physical liquidity bottleneck, transforming paper allocations into a $95 billion market friction event. This flowchart maps the mechanical sequence. An administrative rule change meets a zero-sum constraint, forcing liquidations that result in a market-wide tracking deviation. This closed-loop system drives the outflow, an artifact of rigid fund structures, disconnected from the actual health of the tech companies. For professional practitioners, reading these specific systemic outflows as a bearish macro signal is an error that creates false negatives. The ultimate result of this friction is tracking deviations, moments where an asset's market price temporarily detaches from its underlying value, driven by order flow pressure. These deviations are predictable because the size and timing of the ETF liquidations are dictated by public rules. The resulting mispricings are mathematically certain. Quantitative macro flow traders exploit this architecture, providing the necessary buy liquidity during the peak of the forced selling event. By mapping the underlying plumbing, traders can acquire prime assets at a forced discount, capitalizing on the systematic rebalancing as equilibrium is restored.